Okay, good afternoon. Good afternoon now. And this is I guess we'll call it the Hartnett walkthrough, right? The flow show walkthrough. I don't want to say Hartnett. Anyway, all right, so here we go. We're going to do today, let me share my screen here. I guess I'll just share the whole thing. Okay, we'll come to that. All right, there's GoldFix and big week, bricks, Jackson Hole, a lot of analysis type takes and some reports. Okay, so what we want to focus on today is Hartnett. So before we look at that, let's go context. In this current story, 4 weeks ago, right? 4 reports ago, I should say. I don't know if it's weeks. He said bearish after the last hike. Boom. That has not changed. Not much has changed. He's sticking to his guns here. He then said through the summer and possibly the early fall, there's risk both ways based on financial conditions, which he was looking for to tighten. And they haven't tightened yet. But he's mildly bearish for that period. And, he's been fruitful in that opinion. And then he thinks that because we are, to summarize, right, because everything has been, lagging is not the word he used, overshoot. We overshot everything. We overshot COVID. We overshot the cure for COVID. So now we're overshooting the cure for inflation. I think that's what he means. I mean, I'm almost sure that's what he means. We're overshooting the cure for inflation. Therefore, we will have a lag in the transmission of transmission of the higher interest rates into the economy, and we will have a contraction that if the Fed does not, I remember this now. If the Fed does not react quickly, he doesn't think they will. He thinks they're still in that whole let's keep rates high mindset. Then you could trigger a recession for the next 4 to 6 months after the fall. So assuming the Fed's not going to raise until the end of 2024, Q4 2024, 2025, and assuming that the transmission is delayed in getting to the broader economy, he's right. And if he's wrong, this is my input, if he's wrong, we're going to have inflation, right? The economy lands, I mean, just taking it to extreme. If the economy crash lands, we'll have deflation, right? Take it to extreme. If the economy doesn't crash land, we're going to have resurgent inflation, period. He thinks that we're going to have, more or less, I don't think he's married to it, but more or less we're going to have a recession, possible crash. Crash is not the right word to use. He hasn't used that word yet. A big pullback in the markets. And as the market pulls back, the Fed won't react. And what you'll have is a deflationary problem, but commodities will be stickier than stocks. So it's kind of like it's a stagflation leading to an inflation. It's a stag-session, I guess, right? Stag-session. I like that. Write that down somewhere. Anyway, so that's probably what he's going to elaborate on. I haven't really looked yet. I looked at the title and I'm like, okay, I don't try to figure out what he's talking about from the title. And I'm like, okay, is it about the Russia ending the war? I don't know. But I saw a sentence and I wrote that yesterday. I get it now. So let's look at it for the first time. I have pictures on the right. I'll have the PDF that I'll go through on the left. And I haven't looked at it yet, but here's Zero Hedge's version. Let's take a look at, they're going to be much more granular, and they're going to see things that I'm not looking for. That's why I don't look for them, because I look for them there. All right, so let's get to the PDF. What do we got here? I'm not sure if he wrote a lot. I don't think he wrote a lot today. All right, let's get the picture over here. Split the screen a little bit. All right. The flow show, net zero, which means I have looked, which means he believes that net zero has a snowball's chance in hell of happening. Why? Not a sponsor, but I'll take sponsorship if it keeps the price for subscribers down. He believes based on the new economic policies of the BRICS, or he calls them the BRICS 11, right? And the new economic policies of the G7, and the splitting of the world and all that. He thinks net zero is just not going to happen. You just can't do it. And that's it. That's the whole report right there. And then he goes into why. And then he also goes into looking at further data to determine if his story from inflation to recession is still on track. So let's go through it. Scores on the doors, 38.1%. Let's get to it, right? Scores on the doors, 38.1%. Stocks, 13.4%. High yield bonds, thinking out loud here, gold, cash, commodities. I don't see a big difference. Obviously, cash remains 3%, even though the dollar's weaker in general because of the interest rate that you're getting paid for. Winners and losers, tech's Magnificent 7 up 93%. Okay, so he's going for tech's Magnificent 7 up 93%, versus regional banks down. So that when he says winners and losers, you're looking at sectors. Okay, so the Magnificent 7 are up 97%. Regional banks are down 37%. China real estate bonds are down 55% year to date. Losers still losing, and nouveau bulls hoping no magnificent double top and Magnificent 7. Okay, so the nouveau bulls would be people buying strength, not necessarily FOMO, but people thinking that we're going to another era. Tail of the tape. Let's look at chart 4, right? Let's do that. Chart 4. I'll make this a little bit smaller so we can stay with the full screen there. So there you go. Hoping no double top Magnificent 7. This is key, I think. What Hartnett will do as he goes from big picture to macro to actionable, because he covers those 3 areas, he will need a trigger. And his one trigger that he's mentioned is financial conditions tighten. And if they do, that's going to be possibly a trigger for him. Another trigger that he will use, and I'm not sure if he's he's technical as well. He's looking at this chart and he's saying that's a double top. And if a double top holds, well, there you go. Look, pure, simple technician, right? You get a double top, you short it, and you stop yourself out above it. And if you want to know why, we can get into that some other time. But just broadly speaking, the first time a market goes up and makes a top, that's because it stops there because there's some selling there, right? And that's the market runs away from the selling, or the buying runs out, whatever. But there's selling there that stops the buying the very first time. That's the virgin top, right? The second time up, when it gets to that area, if it tests it, if it stops there again, that means you have the same number of sellers plus more sellers. That means the area is becoming a pile-on. So up, enough selling to stop it. Down, up, enough selling to stop it. Down. Well, that means the buyers knew that there was selling up there, right? Just think about the market as smart. The buyers knew there was selling at this top, right? And yet they still bought it. So, and yet this buying could not get through this top again because the original sellers are joined by other sellers. And those type of sellers are people that say, oh, it stopped there last time, I'll sell it if it gets back to there. Now, as you go further down the line in technical analysis, double tops, triple tops, the more tops you have, the less resistant they are. But a double top is, double tops are tough. So I think, I know he knows what he's talking about. Tail of tape. Okay. Best correlation 15 years is central bank liquidity and tech stocks. Right. So the more money they print, tech stocks do the best. And not just big tech stocks. the Magnificent Seven, but all tech stocks, the companies that are referred to as unicorns, they don't make money because those companies are longer duration and lower interest rates, more money. They can continue to run as a unicorn, meaning they don't make money yet for longer periods of time. So they run on cash flow, not on earnings. So there's your duration concept and central bank liquidity. Central bank balance sheets are down 3 trillion, yet NASDAQ wants new highs. Chart 3, where's that? Wrong way. Chart 3. Global central bank liquidity highly correlated with tech stocks, right? Zero Hedge talks about that a lot. It's almost like these two are talking to each other about this stuff. Zero Hedge comes up with this on their own, obviously. Central bank liquidity highly correlated with tech stocks. Okay, so pointing that out, he's saying, hey, central bank balance sheet is lower, tech stocks are still strong, but they look like they've turned the corner. See how that works, right? I mean, if you can't say this 100% of the time, but you can make the case, right, that the NASDAQ follows the G3 central bank balance sheet. So the G3 central bank balance sheet turns, whether down or up, and then stocks follow with a lag time. Maybe it's a month, maybe it's 3 months, maybe it's 6 months. But here we are. The dark blue line turned lower. It's been lower for several months. And now maybe you're in I'm not sure where the scale is here, but now it looks like the lighter blue line has turned, coinciding with a double top. I mean, it's a technician's dream. You got the double top, you've got the correlation starting to revert to the mean again. I mean, I'm flat right now, but I look at this and I just say, yeah, fuck it, just be short. Okay. We say tech. What's that mean? Oh boy. All right, here we go with this phrasing that I don't get. Central bank balance sheets down at 3 trillion, yet NASDAQ wants new highs. We say tech equals have to trouble rather than error of new AI rules. Okay. He's saying that I know what he's saying. I don't get the right words. Tech follows. At this point, what do call it, the alligator jaw has really gotten far apart because of the AI enthusiasm. I'm not going to call it hype because I believe it's real. I just believe it's ahead of itself. So he's saying that the second half of the year, his words now, won't be dominated by the AI hope. It'll be dominated by excess liquidity running out for Wall Street. So here we go. We say tech. Second half of the year is going to be trouble rather than an era of new AI rules. Like excess savings to excess for Main Street equals excess liquidity to run out for Wall Street. Same idea. That Main Street is saving more. That means that's less liquidity available for Wall Street. Or if the central banks aren't giving them money, then they've got to get it from investors, from Main Street, and Main Street's not giving it up. Price is Right. 25% of Toll Brothers Q3 new home buyers paid in cash. Jobs, fiscal excess, millennial YOLO, boomer guilt economy, U.S. consumer laughing at 5% rates. Okay. Just looking at what he's saying here. That means bullish for the economy. Jobs and fiscal excess, millennial YOLO, boomer guilt economy. All right, so here we go. He's basically saying the economy is still doing well. I think that contradicts his thesis, so to speak. Maybe that's the linchpin that has to break. Who knows? The biggest picture. All right, this is the title. The emerging markets are 80% of the world's population. They produce 76% of the oil supply. They're responsible for 73% of the CO2 emissions in the world. They have 54% of the FX reserves, 46% of the nuclear weapons, but just 20% of the global equity market cap. Chart 2. That's his main chart. All right, so I'm going to say that again because it's when you put all the connecting words in, it's pretty powerful. The BRICS, the emerging markets, are 87% of the world's population. They produce 76% of the world's oil. They also produce 73% of the CO2 emissions in the world. They have 54% of the FX reserves in the world, 46% of the nuclear weapons, and only just 20% global equity market cap. Chart 2. I want to address that sentence. He's saying all these things can change. Meaning the emerging markets, are they going to have less of a population? No, not tomorrow. Less oil supply? No. As long as we're dependent on oil, you have to know that, right? 73% of CO2 emissions. Well, I mean, you know, the less we use, the more we degrowth, the bigger their percentage gets, right? 54% of FX reserve, that probably should go up. 46% nuclear weapons, we're not going to bomb them. We're not going to bomb them into submission, right? And yet just 20% of global equity market cap. I'm going to tell you that in a sense. The West is financial and needs the material. The East is material and needs the financial. As our financials drop, their financials will go up. By financials, I mean their equity market capitalization. As their materials drop, our materials will grow up. This is the world balancing out. I love this because he's not looking at it that way, but he certainly is looking at it that way. All right. And now he creates a new trade bloc. I talk about the trade bloc, the East versus West, Silk Road. He's calling it the BRICS 11. The new BRICS 11 political bloc dominates the emerging markets. They hold 1.5 trillion of US treasuries. Okay. Politics. Okay. So there you go. They're not to be ignored. They're a player. Maybe China is not as big as it was. But when you put it together, it's still a big portion of the treasury holdings. And those are treasuries that will eventually be sold because of all these other things. All right. The politics and policies, that means the stance and attitude and the actual implemented policies of countries of both G7 economies and the BRICS 11 signal the end of globalization. And it is inflationary, and it also hinders goals of net zero and peace. Okay. In macro terms and kind of secular terms, he's saying what we've been saying. I'm not saying that we thought of it first, okay? Mercantilism, collapse and complexity, go to your own corner, build the wall, deglobalization. These are all things that we've been talking about for over a year. And he's been thinking of them, I'm sure, but it just doesn't fit his weekly writing. So you have a world that splits, starts with COVID, without even getting into the whole spiel that I'd like to get into. We'll just put it this way. COVID reveals the fragility of global supply chains. Global supply chains collapse. The East says you're not paying us enough for our stuff, our physical goods, our raw materials, and our labor. The West says we don't need it. Go to hell. You need our financials. And so they go to their own corners, right? And with that, the supply chains break, right? You can't get your stuff from Asia quickly to get it at a cheap price at Walmart. So we start rebuilding our supply chains, okay? And here's what they're not talking about in the West. The East has to build value chains. They have them, but they need to build more. We need to be able to source our commodities efficiently and inexpensively. They need to start, not necessarily China, everywhere else, they need to start adding value to their raw materials better and faster. That's the value chain. Value chain is, supply chain is beginning to end. Value chain is human value added in the middle. Okay, so by the way, increase in financialization comes from an improvement in your value chain. All right, as their economies get better and more self-sufficient and more innovative, their financials go up. So as long as they don't get stupid, they should do better. Our financials will shrink because our innovation doesn't work as well without having the raw materials so easily accessible. So we have to rebuild our supply chains. And that's what's going, that's like a big yin yang thing. All right. So that's what he's saying. Mercantilism is the economic policy. An authoritarian sort of capitalism is coming from the East, meeting the West democratic capitalism, and we're going to have some sort of a hybrid capitalism, whatever, I don't know what you want to call it. That's governmentally, right? And then economically, right, in terms of goods and services, we need to source our stuff better, right? We need to onshore. We need to onshore, friendshore, rebuild, repatriate, and renew self-sufficiency at the raw materials level. They need to do all those things at the finished goods level, with China as the big exception that basically is the engine for the West. All right, so I've said that enough. Weekly flows, small to bonds, small from cash, small but not tiny from gold, and 6 billion from stocks. Okay, so everything's out. Flows to know, 28 straight weeks of inflows, longest streak since 2010. To this point, and where bonds are not going anywhere. Emerging market debt, largest weekly outflow since SVB. I'm a little bit confused about that. What he's implying, how to take that. So let's look for that chart. That's chart 5, 6, 7, 8, 9, 10, 11. 11. Largest weekly outflow for emerging markets. Well, it looks like when you come out of emerging market debt, that's recessionary. But I remember saying last week that out of the emerging market debt into emerging market stocks was not recessionary. So let's just put a pin on that. I might be wrong on that. Tech largest inflow in 10 weeks does not confirm or deny what he's saying. It could be flight to safety, could be the last gasp. We don't know. Private clients, I'm going to skip that. Bull and bear indicator, I'm going to skip that. You can see that. Real assets. All right, I think that's a chart that we all, as GoldFix people, want to see. Well, there's your global stocks underperforming U.S. tech stocks. That's the whole financialization. Where is that? There it is. Okay, most of us know this chart. It's been doing that forever, but now it's turning at the bottom. It turned before, but it's turning at the bottom now. Let's see what he says here. Real assets. His secular view is that in the 2020 regime, the 2020s regime of higher inflation, higher rates, and higher volatility driven by society's desire to fix inequality, by economic policies towards that end, fixing inequality, plus QT, shrinking the balance sheet, redistribution, I just said, and taxation, all that is redistribution. QT is getting rid of easy money. Redistribution is, pay the worker, take it from the CEO, and taxation is tax the company, not the person. We don't know how that will end. Politics, populism, and progressivism. Yeah, it's kind of, populism is historically a leftist politics, the people, and progressivism is also because the historically leftist. That's what progressivism is. Leftism. We want to move forward. Conservatism is we want to be careful. We want to preserve what we have. But populism, although historically left, is now on the right. That's what Trump's popularity shows. Populism is helping the poor, or helping the large amount of people in a country that are disenfranchised. Shia in Iraq, Sunni in Iran, fiscal conservatives in the U.S. I mean, that's a pretty disenfranchised group of people now. All right. So geopolitics, war, self-evident. Environment, net zero. Economy, deglobalization. We went through that. Stagflationary 1970s analog says real assets to outperform financial assets. Did for the first time in a while in 2022. Chart 5. That's this one here. So the first time in a while. The last time I did was between like 07 and 09. Oh, that's because of the great financial crisis. That's not because real assets went up. That's because everything else went down more. Okay, so outperforming doesn't necessarily mean going up. It just means that you want to short financial stocks. I mean, I'm not telling you what to do, but that's the idea. You want to short Western financial stocks that don't have international exposure, and they won't get international exposure because of deglobalization, because of protectionists, because of tariffs, because of national security and all this other horse shit. But it's probably not horse shit anymore. You want to own financial stocks in Asia. And who owns those? Buffett. Fucker's smart. Japan is ideologically Western, but geographically Eastern. So if you own financial stocks in Japan, you'll do well because they'll be the bankers, the financial innovators for the rest of Asia. Damn, that might be good. All right, I got to think about that now. Okay, so stagflation in 1970s analog says real assets to outperform financial assets. I did for the first time. Okay, fine. So there we go. Here we go. Stagflation, right? All right. Real estate, U.S. home mortgage applications dropped the lowest since 1995. Chart 6. Where's chart 6? There it is. Okay. So less mortgages, higher rates. It's now competing. We're at the point where higher rates are now competing for homeowner buyers who can't afford it. The interest. Simultaneously, you have people that are now, we used to call it in the 70s, house poor. Right now, they're house rich. They have 3% mortgages. They don't want to or can't afford a 7%, 8% mortgage on a move-out house. And that's going to continue. They're going to move out of those big houses into downsized houses so they can pay the 7% mortgage, 8% mortgage, but still not spend as much money on the house. The value of houses are going to, I don't know if they're going to drop or there's going to be like everything else, man, there's going to be a spread. Bigger houses are going to go down in value, smaller houses are going to go up. So it's like time for slumlords to do well and time for McMansion builders to, not necessarily builders, buyers to struggle. But the building is happening. This sounds like a contradiction, but it's not. It's in the exurbs, in the affluent suburbs, the big houses, the nice houses are going to go up in price. All right, because there's not enough of them. People are moving there that can afford to. And the people that are moving out of the big suburbs are moving to Florida in smaller condo because of 8%. You know, that's basically how it is. All right. Fixing rates means 60% of homeowners have mortgages less than 4%. Only 9% have rates over 6%. Wow. Still rates having an impact now, and unemployment rate more important than interest rates for housing market. All right, so rates matter, unemployment matters more. All right, he's not looking at it like a shortage of housing, which is something one of the founders has explained to me, and I understand, as basically being there's not enough houses where we need them. He's not looking at that at all. He's not looking at that secular driver. He's looking at unemployment and rates. That's what he does. Double top in home building stocks is a recession signal. Well, there you go. There's a double top. I don't know if that's good or bad, meaning I don't know if that adds to his other point, but it certainly isn't good. Asian imports, Europe and Asia driven by global trade and banking sectors. U.S. driven by Wall Street and asset prices. Asian imports are down 18% year over year. Import of what? All right, well, maybe it's finished goods, maybe it's raw materials, maybe it's a combination, right? But if Asia's not buying raw materials, if let's just use China. If China's not buying stuff, then China's not manufacturing stuff. If China's not manufacturing stuff, then we're not buying stuff. This is the whole macro circle of life that I think he's getting at here. Asian domestic demand is weak, even India imports year over year. Little wonder global manufacturing. There you go. There it is. I swear I didn't read this. Little wonder global manufacturing PMIs are so weak, right? They're not importing shit to make shit to sell shit to us, right? But note service sector in Europe and China also now contracting. Interesting. So the service sector, so your domestic economy, your gym memberships, your massages, your chai lattes, that is starting to drop as well. In Europe and China, but not Japan. Japan is kind of acting like the US right now, by the way. Also now contracting, right? So there's less money to spend, and they're really starting to feel it over there in China and Europe. That's what this says. Global macro, global macro, so reliant on US labor, market, and consumer. Right. If we don't buy shit, the rest of the world's engine, until they stop buying shit from each other, the world stops. So we're kind of causing what's going on in China right now. Rest of the world, and Tina. MSCI stocks, ex-US is down 3% thus far this decade. Okay, so he's just giving us a big picture data run. Global stocks massively underperforming US tech. US economic exceptionalism creates virtuous cycle of strong US growth. Which chart is this? 9. Oh, there's chart 8. I see. Asian demand is weak. No wonder global PMIs are so weak. There you go. The big four. I don't know the big four. What? China, Japan, India. I don't know. Global stocks mass. Okay, so all he's saying is that emerging market stocks have a ways to go to catch up U.S. stocks. I don't know if he's saying that that's something that needs to regress to the mean, or I don't know what he's saying and implication of that, but let's see what he's saying. All right. U.S. economic exceptionalism creates virtuous cycle of U.S. growth, compliant Fed, capital inflows, U.S. equity outperformance. So factually stating that, or at least that's what the narrative is. U.S. economic exceptionalism, we're really innovative, creates a virtuous circle of strong U.S. growth, a Fed that facilitates that, capital inflows from other countries, global reserve currency, U.S. equity outperformance. Boom. Okay. All right. U.S. growth. Oh, this all works until the market ends the compliant Fed, which is what's happening now, by tightening financial conditions. That's what he's looking for. He wants financial conditions to manifest as tighter. Jesus, I hope I'm recording this. I am. We still think 4.2K, that's his technical level. So we got a double top, right? Which should accelerate below 4.2K. That's his technical comment. We still think 4.2K next destination for SPX, but Jackson Hole can flip that September script. All right, so he wrote this for that. But since debt ceiling resolution, higher stocks now mean higher yields. Just as lower for longer rates and yields cause bubble and boom, higher for longer rates cause pop and bust. Great. Okay. That's easy. That's easy for me. Even I get that. All right. He's describing in his own way what Posar said a long time ago. The result of the tightening of the 80s created disinflationary tailwinds, pushing us. So the Fed could accommodate by lowering rates. We stopped spending money. It was fiscal conservatism. The economy reinvented itself. And so lower for longer, right? That's the tailwind. That's the Goldilocks era that started right before Clinton and ended, started in like late 80s and ran to 2008. That's the Goldilocks era. The Fed can do no wrong by lowering rates. Like they waited a little bit. Technology helped, innovation helped, supply chains grew robust, globalization helped us. I mean, it was just fucking awesome, right? So the Fed could be like, I'll lower it today, I'll lower it tomorrow. It doesn't matter. Or I won't lower it at all. It doesn't matter because things were just working in their favor. Compliant Fed. But now, in this era, fiscal spending, geopolitical tension, deglobalization, mercantilism, now those, Posar phrase here, those disinflationary tailwinds are now inflationary headwinds. So now they're slowing us down. So just as lower for longer rates and yields cause bubble and boom, higher for longer rates and yields will cause pop and bust. That's a good title. Why didn't he say that? Pop and bust. I like that. From bubble and boom to pop and bust. Okay. So sell the last rate hike. He's saying it again. Have we gotten the last rate hike? We're not sure. Just as an addendum, you can look at all this. As an addendum, he not he the right now the market is saying it believes that there is a good chance that we're going to have another hike, but not in September. Okay, so it's kind of like the pause is just getting extended. Maybe someday it'll just be stopped, but I don't think so. So let's take a very quick look at well, actually, I'm not going to take a look at it. I just don't want to do that to them. But I'm going to read this later on. Net zero, Hartnett warns the Nasdaq just peaks, while BRICS 11 is end of globalization. Yeah, so that's the title. That's Zero Hedge's title. We say tech, right? Exactly. So you can see how Hartnett writes, right? It's like, ugh, you know, unless you're a trader, you don't get it, or maybe you do, and I'm just dumb. All right, this is a long one. I hope I wasn't too redundant. I hope you got something out of this, but this is where we are right now. It's still on. Nothing has changed. Certainly Jackson Hole after this didn't really change anything. And he's looking for us to go down after the last hike. Finding out when the last hike is, however, is the problem. I'm Vince. Have a great day.